Hi. What I want to talk about right now is the accrued interest adjusting journal entry. So, in a traditional loan, when you go out and you borrow money, let's say you go to the bank and you borrow $10,000 from the bank and the bank makes you sign a note. The journal entry would be a debit to cash for $10,000 and credit to notes payable or NP for $10,000. That's a general journal entry, and the bank would make you sign a note. Maybe it's a 5-year 12% note. We'll just do 12%. It makes it easy. And so let's say this happened on 9/1/16. You go to the bank, you borrow $10,000. The bank makes you sign a note. And you sign a 5-year 12% note. So that's the general journal entry. So then the question would become is, what does 12% mean? And a lot of students, they don't know whether it means per month, per year, for the 5-year term. What does that 12% mean? And the answer is 12% means per year. Just like on your car loan, if you have an 8% loan on your car loan, that's 8% per year. That's not 8% for the 60 months that you have the car loan for. It's 12% or 8% per year. If you have a credit card that's at 22%, that's 22% per year. Not by month, not by, it's just an annual number. So interest rates are always quoted as an annual number. 30-year mortgage, you have a 4% loan on a 30-year mortgage. That's 4% per year on the outstanding balance. So let's say the end of September rolls around, right? So the end of September rolls around, and you're doing your adjusting journal entries, you're adjusting supplies and your prepaids and depreciation expense. But you have this $12,000 or $10,000 12% 5-year note. You haven't made any payments on it, and maybe you won't make payments until October. Maybe you won't make payments until December. Who knows? Really will depend on the terms of the note of when you start making payments. But what you have had since September 1st to the end of the month is you've had the use of this $10,000, right? And so for adjusting journal entry purposes, what we need to do is we need to accrue the interest that has occurred on that note. So the way that we do it, if 12% is an annual number, we take the 12% and we divide it by 12 in this particular case, because you want a full month's worth of interest, and you get 1%. So if it's 12% per year, that's 1% per month. And now what we've had is we've had the $10,000 for 1 month, so we can multiply the $10,000 times 1%, and that equals $100. So we've actually incurred $100 worth of interest on that $10,000 note within the month of September. So once we've calculated the $100, the journal entry is going to be a debit to interest expense for the $100. And I'm just going to erase this to make it easy, but we've calculated the 100, and then we're going to credit accrued interest, or what I like better is probably a better word than accrued interest is maybe interest payable. Either one of those two names of the account. So either accrued interest or interest payable, we're going to credit. Both of them are liability accounts for $100. So if all of a sudden you came into a windfall and on October 1st, 2016 rolls around and you say, I want to get rid of that 12% note, and I don't want to have that anymore, and I'm just going to pay it all back, then the journal entry that you would do is obviously the bank would want their $10,000 plus they'd want all the interest that's happened on that note. And so the journal entry that you would do on 10/1, if you were going to repay back the note and the interest, would be a credit to cash for $10,100. That's the amount that you would have to write to the bank in order to satisfy the bank. You would debit notes payable for $10,000, basically getting rid of your notes payable. If you have a $10,000 or credit of notes payable, and by debiting notes payable for $10,000, it means you eliminated the note. And then you would debit the interest payable account or the accrued interest account for $100. So that would be the journal entry if for whatever reason you wanted to pay back that 5-year 12% note early. Maybe you only had it for the money for a month, so forth. So anyway, hopefully that kind of explains the accrued interest. I want to go over some other interest calculations and how to calculate interest. The reason why we are doing all of these journal entries is for something called the matching principle. So all adjusting journal entries are done for the matching principle. And what we're trying to do is we're trying to match the expenses of, say, September with the revenues of September. So if you can imagine, September had the use of this $10,000. Hopefully we made some money. We had some income that's occurred in the month of September because of that $10,000. And so we want to match the expenses that's incurred with the income that was also incurred during that same period. So it's a matching principle is the reason why we're doing all of these adjusting journal entries.